So he did the belly button piercing for my daughter.
Oh, okay.
And I had no idea he had moved. And she came up this past summer to get more advice because every time she goes to Tuscaloosa. Hey friends, welcome back to another episode of The Homestretch. I'm Nina Soden with the Soden Team here in North Alabama. Your real estate matchmaker and biggest fan of turning homes into long-term wealth.
And I'm Kat Frisby with Victorian Finance, your mortgage guide and finance strategist, here to help you make smart money moves, especially when it comes to real estate investing.
As always, we're licensed professionals, but this podcast is for educational purposes only. For advice tailored to your situation, be sure to speak directly with your lender, your realtor, and maybe even your CPA or financial advisor.
So today's topic is one we love because it's where real estate becomes more than just a place to live. We're talking about financing options for investment properties.
Whether you're buying your very first rental, house hacking a duplex, or you've already got a few doors under your belt, this episode is for you. All right, Kat, let's start with the basics. What actually counts as an investment property in the eyes of a lender?
Great question. An investment property is a property you purchase with the intention of not living in it yourself. It could be a single family rental, a duplex, a short-term vacation home, or even a multi-unit complex.
So a second home or a vacation home might not count if you plan to use it personally.
Correct. If you're living there at all, even part-time, we look at it differently. But if it's strictly for tenants or guests, that's investment territory.
So let's talk loan options. What is the most common way to finance an investment property?
That would be your standard conventional investor loan, typically offered by Fannie Mae or Freddie Mac. Here's what to know. Minimum down payment is usually 15%, but that bumps up to 20 or 25% to avoid higher interest rates or mortgage insurance. Interest rates are higher than primary residences. You're a higher risk to the lender. You need strong credit, ideally 680 or higher for competitive terms, and you need to show solid reserves. Lenders want to see you have enough savings to cover a few months of payments in case of vacancies.
So basically, come in prepared and with cash.
Yes, and don't expect first-time home buyer perks here. These loans assume you're playing in the big leagues.
What if someone wants to get started with minimal down payment?
So if you buy a 2 to 4 unit property and live in one of the units, you may qualify for FHA financing with as little as down as 3.5%.
So you're technically buying a primary residence, but renting out the other units.
Yes, exactly. You get the benefits of owner-occupied financing and rental income. Just know, the property must be your primary residence for at least 1 year. FHA will look at rental income to help you qualify, but you'll need to show realistic market rents. You may need a reserve fund, especially for a 3 to 4 unit property.
What about folks who already own a primary home and don't want to use W-2 income to qualify for a loan?
That's where DSCR loans come in, debt service coverage ratio loans. These are designed specifically for investors. So instead of using your personal income, we qualify you based on how much rental income the property generates. It covers the rent covers the mortgage or gets close. You may qualify. These loans are great for self-employed borrowers, LLCs, or seasoned investors.
So the property has to carry its own weight, basically.
Yes, that's right. So lenders look at the projected rental income versus the new mortgage payment. If the ratio is above 1, you're usually in good shape.
Let's talk about more advanced or short-term options like hard money lending or commercial loans.
So these are often used for flips or larger scale projects. Hard money loans are short-term, interest-only loans with fast approvals but higher rates and fees. Commercial loans might apply for 5+ units buildings or mixed-use properties.
So these are great loans, great tools, but definitely not for the average first-time investor.
Right. Yeah. These come with higher risk and are best used when you've got a solid strategy, exit plan, or experience under your belt.
All right. Hit us with some pro tips, Kat. What should a new investor keep in mind?
So your first rental is the hardest. Once you've got one under your belt, the next one's easier to finance. Track your rental income and expenses. Treat it like a business from day one. Talk to your lender early. Not all banks offer all loan types, and some don't even offer investor loans at all. Don't underestimate reserves. Even well-qualified borrowers can be denied if they don't have the backup cash. Use a team who understands investing, realtors, lenders, CPAs who speak the same language.
Yes, the strategy matters just as much as the property. You need a team that sees your vision.
So let's recap your financing options for investment properties. Conventional investor loans, solid, but require 15 to 25% down. FHA, 2 to 4 unit property, live in one, rent out the other units. DSCR loans, qualify based on the property's income, not yours. Hard money commercial loans, higher risk, used for flips or larger properties.
Whether you're just starting out or ready to scale, there's a financing option out there for you. And the sooner you start exploring, the sooner you can start building wealth. If you're thinking about investing in real estate in North Alabama, I would love to help you find that perfect first or next property.
And if you're not sure where to start financially, or you just want to explore your loan options and compare strategies, let's talk. It's what I do.
Next week on the home stretch, we're talking about buying new construction, what buyers need to know, how it's different from resale, and how to avoid common surprises.
Until then, subscribe, leave us a review, share this episode with someone who keeps saying, I'd love to buy a rental someday.
Your someday could start today. Thanks for joining us. We'll see you next time on the home stretch.
Bye, y'all.
So that is fantastic. Does your company do loans for rental?
We do, yeah.